Welcome to Richard Suttmeier's 4 and 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip is questioning whether or not Wall Street can underwrite $13 billion in U.S. Treasury 10-year notes on Wednesday and $5 billion of 30-year bonds on Thursday. I must admit that I did not expect yields to decline Thursday and Friday, but that's a symptom of the credit crunch. The inverted yield curve is long gone, and the 30-year versus 2-year has widened out to 96 basis points on Friday's close. This credit market stress has pushed energy and swap spreads wider too. The 10-year auction goes well. If it does, this yield can decline towards my annual resistance at 3.737. If not, the nearest support is 4.605. The key will be indirect bids, which could be sparse given the weak dollar. If the 30-year auction goes well, this yield can decline towards my annual resistance at 4.283. Lower bond yields are not justified given the inflationary forces of higher energy prices. Keep in mind that the primary dealers are not in the mood to take on more risk as mortgage-backed securities woes continued. My second blip is wondering how many more credit ghosts come out of the closet this week. We have to wait until November 27th before we see the FDIC quarterly banking profile for Q3, but we are feeling the effects of the weakening bank balance sheets right now. We have seen heightened stress already for the fourth quarter. The issue on Wall Street is credit derivatives, which have grown rapidly over the past several years, and 98% are what so-called credit default derivatives. Merrill Lynch and Citigroup are looking for new CEOs in the wake of their related problems. My third blip is trying to define a credit derivative. The Office of the Comptroller of the Currency defines a credit derivative as a financial contract that allows a party to take or reduce credit exposure, generally on a bond, loan, or index. Our derivative survey includes over-the-counter credit derivatives such as credit default swaps, total return swaps, and credit spread options. Did I lose you? I must admit I am lost in translation. I wonder why the regulators allowed these exposures to grow to such extremes. Between 1988 and 1992, the FDIC administered 1,600 bank failures, and balance sheet issues appear worse during this current real estate crisis. My fourth blip is presenting the statistics that plague the top 5 banks. You can't mark to market, you can't mark to model, you can't value a derivative until there's a willing buyer of a credit derivative at a price. And notional derivatives held at U.S. commercial banks total $152.5 trillion at the end of Q2, and 81% are interest rate products. Credit derivatives among the top 5 banks increased 16% sequentially in the second quarter to an $11.8 trillion total. The OCC says the total credit exposures versus risk-based capital are huge. JP Morgan at 386.6% of risk-based capital. Bank of America 98.5, Citibank 291.6, Wachovia 88.9, and HSBC at 388.3. The only one of these names not in the regional bank index, BKX, is HSBC, so it's no wonder that the BKX is trading at a 2-year low. With all the uncertainties as to what is in a credit derivative and without a method of pricing to market, how can this financial conundrum have a happy ending? If there are any experts in the audience, send me an email to support@rightsideadvisors.com. Tell me how this game can be played out without further and significant damage to the financial markets. That's today's 4 and 4. Enjoy your day.